and alternative source of funding in corporate bond markets, which was expected to replace DFIs, that has not taken off. And the third is, which follows from the second, is really the lack of credit appraisal skills in banks and credit appraisal skills for project finance. Again, there's been a long discussion on this book. And of course, there are other issues like inadequate equity, in Indian, because of these lack of, I think, credit appraisal skills. There has not been enough focus on, the adequate level of equity in corporates so that the risks are not, borne by them. So now these lessons were actually clear had emerged at the time of the first NPA crisis in the 90s, following the liberalization, but these were not fixed. Even though NPAs were brought down from a very high level, as Tamal's book indicates that, they were very high, almost 25% of assets. But these issues, they still linger. And so what is the solution? One is the immediate solution is of adequate capitalization. That is, goes without saying, but over the medium to long term, so that whenever there is a downturn, there will always be a pressure on the banks. For that, you need adequate capitalization. And Dr. Rangarajan has discussed this issue quite well, that how in the when the problem of NPAs was sought to be addressed this time around, the adequacy of the capitalization was not taken into account. And, the speed had to be tempered, keeping that in mind. And the segregation of, loans which have poor judgment and fraud, and implementation of the IBC. And there are two issues I would like to flag finally. One is that the current level of NPAs are not as high as in the first phase of high NPAs, but that was followed by an economic boom. So capitalization took care of part of the problem. The other was of growth. But now if you look forward, you have a problem both on capitalization, and if you look forward, I think we might be discussing the state of the economy later and what is the prognosis. I'm quite pessimistic on the economy going forward, so which would have an adverse impact on the resolution of the NPAs. And finally is, the experience of banking crises is that if they're allowed to linger, it has an adverse impact on growth. It reduces growth potential, and that is what seems to have happened, among other things, in India. And as Tapan had, drawn, I think, a contrast between Japan and Japan and the US on the one hand. Now, even during the global financial crisis, you see the US forced a resolution of the banking crisis early, and it recovered faster than Europe, where it was, for various reasons, it lingered. So I will stop there.
Right. So Anant, if I can come to you, many attribute basically the absence of the corporate bond market to the problems of the NPAs in the banking sector. So how can we develop the corporate bond market in the country?
Thanks, Sawan, and thank you, Professor Sheel, for having me. And Tamalda, always a pleasure to be with you on any discussion. And absolutely fascinating reading your book. Corporate bond markets, and as the panacea, I guess, for the NPA crisis, Sawan. To start with, I don't think the corporate bond market is the panacea at all. Okay, it is one part of, and a small part of, the overall solution. As Professor Sheel mentioned, the reality is our financial services ecosystem needs to fund our growth aspirations. We have tremendous aspirations. We have tremendous potential. At the moment, our financial services ecosystem is in no shape to finance our growth aspirations. Okay, this is an often mentioned statistic. Total banking loans is about 104 lakh crores right now. Corporate bonds is about 35 lakh crores. So let's call it 140 lakh crores. That's about 70% of GDP, right? And that's just not enough. We need a far more higher credit growth. So what is required really, if you want to go to the basic question, I think multiple things need to happen. Nobody comes out of this last 10 years looking good. Okay, neither investors and analysts like myself, nor bankers, nor auditors, nor rating agencies, nor regulators, nor government, nobody. So, it's a bit like what Tamalda discusses in his book. No one killed Jessica, which means all of us killed Jessica. It's a collective murder. It's like the murder on the Orient Express. Which also tells us that the way forward is, forget about the past, the way forward is, there is a bunch of things which have to happen. And in the, I think it was 2016 economic survey, Dr. Arvind, Subramaniam came out with this 4R framework, right? Which is recognize, recover, recapitalize, and reform. I think those 4 R's have to go through. Recognition, I'll just quickly point to 2 of the R's. Even today, our national motto is Satyameva Jayate. We have trouble recognizing the truth. We still have forbearances. We still have, SME, Mudra loan, doesn't matter, pretend it's all fine. We still have NBFCs, which are far, far from the numbers given for NBFCs, NPAs are ridiculous. My daughter, who's a biology student, will tell you it's wrong. Okay, who doesn't know the first thing about finance. So clearly we have trouble recognizing the truth, and we never find a good time to recognize the truth. It's always, no, abhi mushkil hai. Now is a bad time. Let's wait for 5 more years, 10 more years, 100 more years. And in the meantime, we are living in fool's paradise. So recognition is a big problem. Resolution, IBC is good. It's a fantastic piece of legislation, but it's not geared to handling this size of NPAs. And that's a problem that we'll have to find out a solution to. Recapitalization can happen. I don't think capital is a problem at all. I'll quickly touch upon reforms where corporate bonds comes as well. In reforms, very quickly, 60% of banking, as Tamalda also said, is public sector banking. I don't think the problem is really government ownership. The problem is government interference. The fact that you have telephone banking possible in 2009, 2013, the fact that you could have Mudra banking and Shamiana banking now, the moment you have Babus and Netas getting involved in commercial banking, you're asking for trouble. By the way, so in Singapore, DBS is owned by the government, but there is an entity in between, Temasek, which at least prevents the government from interfering in day-to-day operations and saying don't borrow, don't lend, or you can't pay, Dinesh Khara, who's the chairman of SBI, more than 30 lakhs in a year, which is ridiculous, doesn't make sense at all. So, giving some kind of professional autonomy to public sector, even if you don't privatize, is absolutely important, which is why I think that PJNI committee recommendations are super critical for clearing that part. Mind you, this is not about governance. Governance issues are ownership neutral. Whether it is private sector banks or public sector banks or foreign banks, we are all crooks. So we need, cleansing of governance, whether it is rating agencies, auditors, boards, risk management, supervision, all of that cleansing has to happen separately. Corporate bond, very quickly, Son, look, it's been growing, right? 35 trillion rupees, it's been growing. But if you, and why is a corporate bond market good? It does a couple of things. One is it helps in maturity matching, right? So if you have an insurance company and if you have a pension fund, which typically has long-term liabilities, that's best geared towards funding infrastructure and long-term investments. And a corporate bond market allows you to do that. Second thing is it brings in some transparency. So rather than having an opaque loan, over-the-counter loan system where nobody knows what the loan documentation says and you are going on the Ram Bharose, some rate and some pricing for the loan, at least there is a market to determine what should be the price of a particular credit, right? And so in theory, it's great. I think the progress is being made. And absolutely, I think we do need that market to progress. What can be done? Lots of things can be done. To start with, we can make trading in corporate bonds a lot more easier. If I'm supposed to be a bond markets person, but I will never buy a bond other than a tax-free bond in my name directly. Moment I do that, the amount of tax I pay is ridiculously high. I'd much rather buy the same bond via a mutual fund and pay much lower taxes, which makes no sense at all. So the trading culture you have in equity does not exist in bonds, even though a lot of people have views on bonds and on interest rates. There are other things, including besides tax, including, for instance, the growth of the derivative markets, getting in more transparent trading screens, which I think SEBI is working on. So those things will happen over a period of time. But it's not just one thing, Sawan. I think a whole bunch of things have to come together, and corporate bond markets, along with other reforms, is just a part of that.
Sure. So if I can turn to you, Mr. Bandyopadhyay, Would you throw some light on the EQR process and the risk framework that RBI has?
Well, this AQR is actually the, the instrument which Reserve Bank of India used um, to expose to use a cliche, soft underbelly of Indian banking. Bankers were hiding, and they were not telling the truth in the sense they are not recognizing their health. They are in a denial mode. The reason being multiple reasons. One of the reasons could be the main reason could be they were short of capital. Because once you have NPA, you have to provide for it. Then your capital gets eroded, and then forget growth. Even survival capital was not there, because you remember this 2.2 trillion plus recap, which our former finance minister, Mr. Jaitley, announced. It was post AQR and all. So one is capital. Second, of course, again, the very structure of public sector banks, because the CEOs are there, unlike Aditya Puri's 25, 26 years, they are for 2 years or 3 years. Earlier, it was even for 1 year. So why do you want to get into all this trouble? So let it be like, keep it open, keep it closed, and then leave with a good note, pleasant note. There are multiple issues. So first, Reserve Bank of India what it did is sometime in 2014, they put this database called Cleric data, which essentially the real-time information of all accounts, 50 crore plus account. And that actually set the ball rolling, and that made Reserve Bank of India see that how there's a discrepancies, how one particular account is good account in one bank's book, but a bad account is another. So that exposed actually what the bankers were doing. And then this one of its kind globally asset quality review came, which essentially I'm a regulator, I don't trust your audit. I let my people go and check your books. And that's what happened. It's let loose its own inspectors to each of the banks, depending on the size of the bank, the number of inspectors, and their positioning in Reserve Bank of India. That happened. And that actually exposed the entire thing, what was happening. And my book graphically describe how it was like a control room 24/7 operated by Reserve Bank of India, away from the public glare, not in the central office but in the corporate office. And here there's a real time people are finding out what was happening. Just to give an example, and I mentioned that it was found that in one particular large bank, one particular account is not paid for 89 days or something like that. As you know, there's all the technicalities, SMA 0, SMA 1, SMA 2. So 90 days it becomes, on 90th day it becomes an NPA if the money is not paid. So the banker was asked, the CEO was asked that what is happening? This fellow is not paying, you are not classifying. And he was told that no, it is coming. Typically it's been paid on the last day, so we are comfortable, we are happy that it will pay. It will come. And exactly this is what happened. On the 90th day, the money flowed in, and the account was saved from being converted into a bad account. That's fine. But then the same inspector found that the money got into this bank account, but the very next day the money left this bank and got into other bank account. I'm talking about, it's a combination of AQR and Cleric data. So, and then what was happening is this: what was 90th day for this particular bank A was 88th or 89th day for bank B, and then probably or 87th day or bank C. So the same money was getting out and getting in and getting out and getting into other bank and all, to keep the accounts are all good shape. So what happened in a consortium lending, you sanction loan, but you disbursed accordingly. So I disbursed is today, you disburse is tomorrow, Anand disburses is day after tomorrow. So the particular account, the borrower has the always 24 hours window to give money to you and money to me, and then the money leaves my bank and goes to your bank, and then the third day it leaves your bank and goes to Anand's bank. So that was the game RBI the bankers were playing. They got exposed, and it was found that they were not doing things right, and they need to they need to show what's the problem. And there are a lot of discussion within Reserve Bank of India. There are a lot of I would say there's no unanimity what should be done, but ultimately Dr. Raghuram Rajan's thing prevailed. They were given 6 quarters to come up clean. So it started post AQR. AQR was done in July, August, September, around that time in 2015. And the bankers were told that you provide for all the bad assets and come up clean with all your bad assets in 6 quarters, beginning December 2015 and ending March 2017. So last quarter of 2015 calendar year, 4 quarters of 2016 calendar year, and first quarter of 2017 calendar year. Those 6 quarters. And if you look at the data of the bank's NPA growth, etc., you will find there's a dramatic rise from December 2015. From December 2000, and there's another interesting part, Reserve Bank of India have stopped giving now. I think till 2019 they were giving. There are 2 parallel charts where the restructured assets and NPAs. Now you will find till 2015, restructured assets were pretty high, NPAs were very low. But in from 2016 onwards, the NPA line was catching up with the restructured assets. And now it's almost the same. What does that mean? The banks were hiding their NPAs under the pile of restructured assets. After AQR, they have no choice but to expose themselves, and NPAs came up. So the entire thing, but unfortunately, by March 2017, it did not end. It got spilled over. And as we speak, at least three banks in the public sectors ended up having gross NPAs between 1/4 and 25 and 30% of their total bad assets. IDBI Bank, UCO in Kolkata, and IOB in Chennai. All the 3 banks you'll find that 2019, they are around 30%, 31%, 28% kind of bad assets. And of course, rest everybody also came up. So that's the story. It's quite a sensational story. It's like RBI was working like a Scotland Yard. The last bit you spoke about the entire risk management. I mean the risk appraisal. I mean how RBI's inspection and all it happened. One of the reasons, and that's linked to not exactly to NPA but increasing number of frauds. Because what comes today in the as identified as a fraud account, but actually the fraud happened a few years back. So 2019 or 2020, the sudden spurt in fraud does not mean that they all happened in 2019 or 20. They are all legacy frauds happened in 2014, 15, 16, etc., etc. The reasons being, or the primary reason being, around that time, 2013 and all, RBI shifted from CAMELS-based supervision, CAMELS, where there's an acronym and each of the letters stands for certain things. Only S is meant something for India and something else for the globally else and all. So CAMELS to risk-based supervision, RBI shifted around 2013-14. And the basic difference between these, apart from the complexities and all, lack of understanding by the banks, etc., other part is this: the focus is much less on site supervision in the risk-based supervision thing. CAMELS was much more focused on on-site supervision. So, for instance, all the important branches, foreign exchange branches, etc., were under the glare of on-site supervision. But in the risk-based supervision, that was not done. And which is why probably the Punjab National Bank, you will see the foreign exchange branch, which is 100 meters away from Reserve Bank of India headquarters in Mumbai, on the Hanuman Circle. This Punjab National Bank foreign exchange branch is responsible for 2 billion plus fraud, LOU fraud. Had there been on-site supervision, it would not have been done. So CAMEL shifting from CAMELs to risk-based supervision, there's a price to pay which RBI had done. And now, of course, RBI in an introspection mode, there's more focus on on-site supervision. And of course, as we speak, I think last week, RBI announced the formation of a special college to look into all this inspection and supervision under the leadership of former Reserve Bank of India Governor, our Deputy Governor, Mr. N.S. Viswanathan. So RBI is addressing all the issues and plugging on the loopholes. But one of the reasons why you have seen increasing number of frauds, etc., is probably shifting from CAMELs to risk-based supervision and lessening the focus or diluting the focus on on-site inspection. Thank you.
Right.
Please.
Great. So, Mr. Bindra, if I can come to you now, do you think that the technology companies can become the banking sector's biggest competitors? And what role do you see for digital-only banks? Can some of these frauds, etc., be averted if we go more digital?
Thank you very much, Charan, and thank you for having me on this very distinguished panel. Tamalda, I haven't yet read your book. I'm sitting in the UK and I ordered it, and it's still making its way to me
Thank you.
right now. But I did go through a very, very comprehensive summary, and at least one thing I suspect I have in common with you, that I also do not know anything about banking and finance. It's far more about other topics, which include some of the technology related topics to it. While people might not believe you when you say that, you certainly have to believe me when I say, because I haven't written such extensive columns, articles, books on this sector that you have. Let me start with a little story to answer your question, Sam. So I came to the UK, I'm in Cambridge, and I came here about 4 months back. And one of the first things I did was to set up a small limited company, which I did from India. It took about 12 hours to set the entire company up, a limited company where I'm a director, etc. But then, a limited company is useless unless you have a bank account, a business bank account attached to it. When I came here, I realized that until February of this year now, I could not open a business bank account in any high street bank in the UK, irrespective of the money I bring in, irrespective of the kind of business, irrespective of the credentials or the references that I might have. I could not. And these are very big banks: Lloyds Bank, HSBC, Barclays, etc., etc. And the reason was that they had been inundated because of the newer kind of loan policies, overdraft policies, etc., which the government had brought in to help the common, help customers and help trade and business, etc. Along with the fact that most of their people were working from home, and they had not yet been able to set up the right processes with the right security mechanisms, etc. And so no one coming into the UK could do any business for 6 months. They could not open a bank account. Then I learned I knew of them, but then I started exploring these, what are called different things. They're sometimes called neobanks, sometimes called challenger banks, sometimes called digital banks. And the UK has been one of the countries which has opened out to these, regulation, etc., much earlier than some of the others. It took me about 36 hours to open a business bank account in a app-only bank, only an app, no branches, no ATMs, no nothing, called Monzo. And by the way, Monzo is not a scam bank. It has tens of millions of customers. It is protected by the same laws, which, my money is protected to £85,000, etc. The same way that the high street banks do that. I can do pretty much everything that I can do out of a high street bank. It's much cheaper. And for the love of God, I'm not able to contact anyone at a high street bank at any point of time. Here, through a messenger, through voice, through the app itself, I get a representative, quickly. And the amount of deposits that I need to pay into the bank to open it is the sum total of £0. Now, how is it that in the same situation, a certain kind of banks can do business while, your 80-year-old, 100-year-old, 300-year-old, amazing legacy names, brands cannot? And the answer, very frankly, has to do obviously with technology. One of the things that Bill Gates said, and it's a reasonably famous quote that he had many years back, is that we definitely need banking, but do we need banks? And so, is there a way to do banking without actually an institution of a bank? And I think in many ways, we are reaching that scenario essentially because of the suicide that the existing banks are committing themselves, not because of anything else. I mean, I'll keep it general. I will not refer to the specifics of the Indian banking system because, as I confessed right up front, I'm fairly of an ignoramus in that specific area, etc. But there is things which technology can do. Some of the things that all of you gentlemen spoke about, which sometimes will make it difficult for the pandemonium, for the frauds, etc. That we've been speaking about. Technologies which can give transparency, technologies which can give accountability, traceability, which can make the approach far more customer focused, which can in some sense replace on-site supervision, where you don't really need people. It could be, I mean, the whole PNB fracas happened in Mumbai. One of the reasons I believe was that the bank was entirely not even on the core banking system. The core banking system, certain parts of it were outside, and so the left hand never knew what the right hand was doing. I will speak about how digitization and digital transformation, perhaps if we have time, a little later, but I'll quickly come to the, can technology, so there's these neobanks, these challenger banks, but I think the more interesting part is, can some of these big, massive technology behemoths, whether it be the Amazons of the world or the Googles of the world, or even Microsofts or Facebooks of the world, can they become banks? Actually, there are many articles which say that that's what really all these technology companies want to become. Eventually, they want to become a bank. You see, they have this one thing, which all of us have, which all other companies also have, but they use that thing much, much, much better. And that thing is actually called data. These are all really data companies. They're not really technology companies. They're really data companies with data-focused business models, and they use technology to make money out of data. I mean, Amazon, for example, famously knows that you're pregnant before you do, because certain bodily impulses make you search for baby stuff, and its massive machine learning or algorithms crunch that data. Millions of women have been doing that earlier, and it spits out first trimester, second month. Now imagine if Amazon was to get into healthcare, which it's already been trying to do. And so what is happening is that we are realizing, all of us, including them, that this era of free data is getting over, and that's a different discussion, but it is. And so they need to now look for other business models than just monetizing your personal data. And one of the most lucrative model which is out there is actually the banking model. And I'm saying the banking model, not banks, different things. And you see the moves. For example, Apple now has tied up with Goldman Sachs and has brought out this Apple credit card, and is, Google with Citibank, Apple Pay, Google Pay, pretty much is replacing credit cards across the Western world, and soon will in India also. And so the primary interface for the customer is becoming the tech companies rather than the banks themselves. And the tech companies, therefore, will own the customer, and the banks really become engines at the back end. And so I think there is this, it's already happened in China with Alibaba and all these, and what you saw of the Ant Financial fiasco literally was this fight between, this battle between established banks and newer entrants in many ways. And we're going to see a lot of that happening. And so I think there's going to be a churn happening. We will have these neobanks, which are startups, but we'll also have these big established companies coming in, and technology by itself will hopefully bring in some of the transparency, accountability, traceability that will prevent some of the evils, if it may, that Tamal and the rest spoke about. But on the other hand, it possibly might bring in a few others, which would be an interesting discussion going forward. So back to you, Sal.
So we move from fintech to tech fins, apparently. Yeah, moving on to you, Anant. What about the IBC? I mean, your views on that, whether it is working well, what else needs to be done?
Thanks, On. Look, as I mentioned earlier, I think the IBC is a fantastic piece of legislation. Okay, and it's been in the works for a long time. While it came out in December 2016, it's been discussed for a long, long time. What does it do? I think it comes close to being a good international standard bankruptcy law, which gives a time-bound resolution and forces the ecosystem to come to a resolution. So why is it that the problem is still kind of festering and looking beyond just COVID? Of course, there is a standstill during COVID, but even beyond that, it's been festering for a while. One is, of course, there are teething issues. No legislation can be perfect when it comes out, especially a legislation of this magnitude. And therefore, there will be a requirement for teething, changes, etc. And second is there's been litigation. But beyond that, I think the larger issue really is the sheer size of the NPA sound. So, the outstanding NPAs, gross NPAs of the banks as of now is about 8.5 lakh crores, give or take. But what people kind of tend to overlook, and Vivek Kaul put this out very well, he actually looked at what amount of NPAs had been written off. It's not been resolved, it's just been written off, right? That's another 8 to 9 lakh crores, 8.5 lakh odd crores. So the actual outstanding NPAs which need to go through an IBC type of a resolution mechanism is like 17, 18 lakh crores. And this is pre-COVID. Can you imagine what it will look like after COVID? Now, if you have so many loans and of such magnitude, there is no bankruptcy system in the world that can gear up to this kind of scale. Of course, Mr. Binder put very well as to how technology can help. I'm sure that, by the way, I have to confess, I don't know the first thing about technology. I barely can plug something in and make it work. But I'm sure there are solutions that possible there as well. So, which is why a one-time solution for the current NPA crisis is probably required for. And Tamalda spoke about the poison coming out of the churn and the Neelkant, the requirement for Neelkant. One of the whispers we've been hearing about is the possibility of a bad bank being kind of revived all over again in the budget. I do think it could be a good idea. And I know it's a controversial point. In fact, people like Dr. Rajan have absolutely screamed against it and stuff like that. But I do think there is a good case for a bad bank. And to me, the case that makes sense is the parallel that was used in Malaysia. So after the Asian crisis in the late 90s, Malaysia had a tremendous amount of NPAs, 30, 40% plus, okay? And largely in palm oil and real estate and infrastructure, etc. They came out with a bad bank, which they called Dana Harta. And the way it worked very quickly was the following. This was a bad bank created by the government. It is owned by the government. It was manned by professionals, including by foreign professionals, which is very interesting. Mahathir Mohamad, if you remember, was the guy who was railing against foreigners for, playing around in Malaysia. And he brought in foreigners to run this bank, okay? And what did he do? He got these experts to give a price for every single large bad loan. So if your loan is worth 100 crores and the recovery experts think it's worth only 40 crores, so you say, I can take it off from you at 40 crores to all the large banks, okay? Now, the problem is the banks have not provisioned down to 40, right? People have provisioned maybe up to 70 or 80. So what do? So you have two choices as a bank. Either you sell at 40 to this bad bank, or if you say no, 40 is too low, that's fine. You keep it on your books, but you mark it down to 40, which means at least you take the P&L hit and you reserve for it. Now, the problem with that is what stops the bad bank from quoting extremely low for everything, and forcing you therefore to take a markdown at a very low number. So the way it worked was the bad bank, if the actual recovery, let's say, was 70 over a period of 3 years, so which means you recovered 30 more than where you purchased it, 80% of the profit you give back to the original bank. So out of that 30, 24 goes back to the original bank. So there was a nice, quid pro quo, which kind of enticed the banks to get rid of the NPAs and give it to the bad bank. How did that help? And by the way, that collation happened. Okay, how did that help? A lot of the NPAs, as in the case of India, was because of government policy. Coal mines being banned in our case, or 2G licenses cancelled, or other things happening, right? When you consolidate the bad loans into one owner rather than having 16 lenders trying to figure out how to coordinate, the way to resolve them becomes easier. You can change regulations. You have one person taking the call, and you're doing it in a time-bound fashion. By the way, Dana Harta closed shop in 5 years. It doesn't exist now. So it was given a time-bound regime that you have to close down this time. And of course, they also did a lot of extraneous things, including changing regulations, etc., post facto, etc. But nevertheless, it worked out pretty well. And they achieved a recovery of close to 60%, which was an all-time record for the Asian crisis. Okay, worked out extremely well. Now, the problem with the bad bank, though, and the valid criticism which comes out, someone, is that this is good money after bad, right? You're throwing good money, you're giving the capital, you're doing the recovery, you're doing all the hard work. And then the bankers go back to doing the old business of, again, creating bad loans, right? Which is why a bad bank by itself is not enough. You have to go alongside with that with reforms. And what we discussed earlier, which is, whether it is public sector reform of PJNI committee or getting some distance between Delhi and the bankers, giving a level playing field, make the public sector bankers also under Companies Act rather than under Bank Nationalized Act, get them out of the clutches of CVC, CBI, CAG, etc. Allow them to hire and fire, allow them to pay market prices to their own people, right? And hold them accountable in a board fashion. And of course, all the governance reform. So it has to go alongside. So here is I'm an armchair professor, I can give this gyan and move on. So as an armchair professor, my gyan is, IBC is good. It is good for a flow business. So which means once you've sorted out the business on an ongoing business, IBC can take care of the NPAs as they arise. It cannot handle the stock. The stock is vast. And even the Chapter 11, the US would struggle with this kind of sizes coming through at the same time. There's simply not enough in the pipe to manage this. So you do need a one-off solution, but that could descend into being good money after bad. And therefore, you have to ensure that reforms and accountability goes along with these, with a bad bank solution. But I think it is inevitable. Eventually, if you want the banking system to finance growth in this country, you have to do this cleansing that Neelkant, that Tamaldas spoke about, has to happen.
Right, great. So coming to you, Dr. Sheel, post the global financial crisis, should we have financed industry in a different way than we have done? Or, what is your take on that?
Okay, the battle of ifs is never lost. Let me start by saying that, on the eve of the global financial crisis, the huge stock of NPAs had been brought down to a level where you could say that the banks were adequately capitalized. Now, what does adequate capitalization means? And what is capitalization for actually? It is that it is well known that you will have, you have the business cycle. And once you have a downturn in a business cycle, which will happen from time to time, NPAs will rise. And these NPAs will be resolved in two ways. One, when growth returns, it will fall down. And then the ones where, the businesses fail on account during the downturn, you have the capital provisioning as a cushion. So, but the Indian bank, when we come to the boom of the first decade, it was actually an economic boom. It was not a financial bubble. So, the credit growth, there was a demand for credit. The problem was that the credit, what you call assessment, did not take into account, maybe because the banks do not have these skills in project financing. They should have factored in the fact that growth is above potential. They assume that growth is, we are going to continue to grow at 9%. So when growth declined, the cardinal sins ensured that these would translate into high NPAs, more than what would have been expected in the absence of these cardinal sins. So I would say that to some extent, you had these flaws in the system. So how would the bankers have? How would that have influenced their decision making? Should they have been far more conservative? Conservative, one, in taking into account that growth is above above potential. But secondly, if the bankers had known, okay, we have these problems in the banking system, and even if we sort of don't lend as aggressively, then what you call our loans would not turn sour. So that's a difficult thing to answer. As I said, it's a battle of ifs. The growth was real, so there was a demand for credit. In hindsight, it is easy to say that they should not have lent, but then you would not have had that level of growth.
Yeah.
And this was not a growth. It was not as if it's an India-specific growth. This was a growth across emerging markets.
Right.
But it is because of these weaknesses in the banking system that it translated into NPAs.
So if I can turn to you, Tamalda, and focus on the NBFC segment, because some of the problem actually then started in the NBFCs, and we've seen all of these, the infrastructure related NBFCs giving us a lot of headache.
Well, I think you are hinting at without naming ILFS. That's a separate story altogether, because in India, I think we experimented with two infrastructure financing companies. One is ILFS and one is IDFC. Both of them have failed. IDFC had to be converted into a bank, which is why it got the license. I mean, otherwise, there's no reason. If you remember 2011 budget, when Pranab Mukherjee spoke about giving banking licenses, it was meant for financial inclusion. Now, IDFC got the license not for financial inclusion, because so for him it was not an application for license. I think it was a mercy petition. Otherwise, IDFC would have gone down under. Of course, it's a very different story than ILFS. ILFS is a story of fraud, misgovernance. So wherever we have tried this infrastructure financing company, there was no responsibility, there was no accountability. It was allowed to do the way it was. And the previous MD and CEO of ILFS ran like a promoter, but left like a professional. We allowed him to leave. So that's a separate story. Let's not discuss that. It's a very unique case. But overall NBFC problem, which we saw in 2018, I think it was a banking problems spilled over to the NBFC turf. Why I am saying this, you remember, post AQR and post what was the real health of the banking system, 11 banks were under PCA. So they were not allowed to give fresh loans. So it was a sort of, in football, what are you calling, walkover. The opponent team did not even, there was no opponent team. So the NBFCs had their entire ground for themselves, and they grew like anything. And they took advantage of the cheap money at that point of time. And 2018 was the time where then RBI governor started closing the tap and hiking the rates, and the short-term rates rose around, I think, 150, 170 basis point. And that created the problem, the alarm bell rang, because all these NBFCs had massive asset liability mismatches. They were borrowing short and lending long. They are just getting 90-day CPs and rolling it over. I think one of the foreign brokerages or research houses came out with a report sometime in late 2018, post that NBFC crisis, and dissected what was the exposure of short-term CPs on their liability side. It was, for some of them, it was as much as 40% or so. So it was, as I said, it was a sort of, apart from other issues of governance issues, etc., it was primarily an asset liability mismatch, which is why I call it a Northern Rock moment, and they had to fall. And there was, my understanding is this, at least for one particular entity, I would not name, there was an asset quality review. AQR was there. Of course, it was not officially said, but they did find out something. And they did find out all those wrongdoings were happening. What I heard Professor Anandranan talking about, the NBFCs NPAs are pretty high and they are hiding it. Yes, of course, it's not the correct picture. There are a lot of they're not telling the truth, not all of them at least. And the other dimension is, of course, the problem with the HFCs. On the one hand, there's a very soft touch regulations. There's a gray area. NHB was a regulator, which is a completely failed regulator. Now it has come to Reserve Bank of India. And on the other hand, the people running HFCs were not, you will see that they are called HFCs, but the kind of exposure they have to the corporate sector, I mean the wholesale segment, not the retail segment. So that's, of course, that created all sorts of problem. And NHB was a sort of very ineffective regulator. Under the NHB Act, I think it could not impose a penalty beyond a few lakhs or so, which is why you will find that how Diwan Housing was found doing things which was not exactly correct. In the sense, they were restructuring bad loans without the approval of the board. And they were found, it was found, and they were penalized some piddly amounts because under the NHB Act, regulator could not punish them enough. So it was a combination of banking sector crisis spilling over to NBFCs because the banks were majority, and then a lot of banks were not, as I said, 11 banks were not allowed to lend. So NBFCs were grabbing the market with both hands. It was a liquidity sugar rush post demonetization, and they were getting they were getting cheap money and rolling over the short-term liabilities to create long-term assets. It was a problem with the HFCs. They are floating all sorts of rules, but a very ineffective regulator either could not detect it, or even if it detected its capability to punish them was extremely limited. So there are at least 3 dimensions, and that's what we had. And ILFS, of course, is a separate story, as I explained to you. Now, of course, the HFCs are being governed by Reserve Bank of India, and RBI had a discussion paper, and now they have come out. They were given a glide path. What can they do? What they cannot do? They need to bring down their exposure to corporate lending and wholesale lending within a certain time frame, etc., etc. I think things will get better. But yes, that was the situation. Thank you.
Thank you. So, Mr. Bindra, if I can come to you about, so, demonetization has been mentioned, and many things happened post demonetization. But again, due to the pandemic, we are seeing an increase in digital payments increase. It has gone up significantly. What scope do you see for the digital transformation in India becoming a more permanent kind of move that after demonetization, 3 quarters after that, we went back to cash again. What do you see post the pandemic this year, next year? How do you see that?
Okay, COVID has been obviously the defining intervention of this decade, or probably certainly more than that. And a lot of people are calling COVID this black swan, something which is unpredictable as well as disruptive. I don't think COVID, frankly, was a black swan, because it was entirely predicted that a pandemic like this is going to happen. What was the black swan, however, were the lockdowns which accompanied it. No one predicted those. And the lockdowns are the one which kind of, which disrupted everything and which kind of caused all the issues that we see right now. The very interesting thing about COVID is this paradox, which in one of my books I call the Covet Paradox, which is that COVID actually slowed down the world, but it accelerated change. And it's very interesting. It did slow down the world. All of us had to stick to where we were, travel stopped, airlines stopped, etc., etc. But things which were slowly happening, many things, suddenly started happening much faster in an accelerated manner. Obviously, the most common example of this is working, and working from home, working from anywhere. The future of work was supposed to happen over the next 10 years, 20 years, which would have all these things. But it kind of just happened like in a couple of weeks. Now, the same thing can possibly be talked about, payments and then the whole digital landscape, etc. Usually they say that it takes about 20, 21, 22 days to build a new habit, and about 66 days, according to all kinds of research, for this habit to become a behavior. Now, many of our lockdowns have actually been more than these 60 days, 65 days, 70 days. And many things that we had to do because of the lockdown will, going forward, some of these will become habits, some of these will become behaviors. The other very critical, very important thing that happened was that people who had been paying lip service to digital and to technology very rapidly and in an accelerated fashion became believers. So if you think about the last 7, 8, 9 months, the companies which were 100% digital which were actually anti-fragile. They actually boomed in the crisis. Companies which were 0% digital stopped, and the companies which were somewhere in the middle, parts of it worked, parts of it didn't. And so this whole clamor for digital transformation now, that how can I become I cannot, not every industry can become 100% digital, but how can we become as digital as possible? And I think that, and how can our business models become as digital as possible? So, for a retail outlet, it would mean omni-channel retail plus e-commerce, healthcare, semi-digital, semi-physical, education, semi-digital, semi-physical. And I do think that the same would therefore move to the same feeling or the same need is moving to all sectors, including the banking sector. Now, actually, if you look at it very dispassionately, the banking sector has actually been, from a consumer or a customer point of view, been more digital than many others. Even in India, the same old thing of the last time that you went to a bank, or the amount of times that you go to an ATM, etc., etc. But all of this is actually in the top 5%, 7% of the population. The challenge is that how this could become more digital, going below that. If in some sense the demonetization was a stick to become digital, which didn't work, perhaps these disruptive events will be the carrots, which would mean that this is the only thing that you do. Otherwise, your business pretty much stops. Across the world, this has forced all businesses, including banks, COVID especially, to become more and more digital. And I think the same thing is going to happen in India. If I again go back to close on the example for my own personal story, or my own example for the neobank, the reason that they could open my account while the others could not was because most of their processes are digitized, because technology has replaced human intervention. The high street banks did not have the people available to look at my credit rating, to kind of figure out whether I was a good credit risk, etc., etc. AI and multiple other technologies did that for the neobanks. They went up and crawled my credit scores and got that out. It went to my social networks and figured out what kind of person I am. LinkedIn to find out what my professions, etc., are. And therefore, this whole automation, which is intrinsic to the business model, help them make so. There was a very interesting comment which was made by Haresh Chawla, one of the venture capitalists and the great commentator on digital things in India, who said that because of COVID, now there are going to be two types of companies or two types of banks, if we were to talk about banks in specific, the digital and the dying. And I think we've talked a lot about the dying during this conversation, and possibly one way to go out of that is to become digital, because the companies which will be the leaders in any sector, including banks going forward, will need to be tech at core. They'll need to be technology companies, not necessarily banking companies. The greatest retailer is a technology company doing retail, not a retail company doing technology, which is Amazon. Airbnb is a tech company doing hospitality. Uber is a tech company doing transportation. Swiggy is a tech company doing deliveries. Now, how do banks become tech companies doing banking rather than banking companies doing technology? Which is what the latter is what is trying to happen. And so I think this particular crisis will accelerate that process, hopefully also in India. Back to you, Tom.
Thank you. Dr. Sheel, if I can come to the recovery, you have talked about the swoosh in one of your articles. Do you still see a V-shaped recovery for the country, or are we looking, has the vaccine changed anything as far as the recovery is concerned?
Okay, so when we talk of the recovery, I think we need to make a distinction between a rebound and a recovery. Now, we had a very sharp decline in growth, one of the fastest one of the steepest in emerging markets. And the current estimate is that in 2021, there'll be a decline of minus about 7.5% annually. Quarter, I mean, the first quarter, about 25%, but overall about 7.5%. Now, to that, so if you want to return to the baseline, if you just do the math, which is what a V-shaped recovery would entail, to this minus 7.5%, you add a further 5.5%, which is what the economy would have grown normally. And 5.5 is a fairly conservative figure for growth, which means that you have lost about 13% of GDP of output. And now we go on to the next financial year, 21-22. So if you want a V-shaped recovery, you will have to grow at around 18%. First, you recover this 13% plus 5.5% growth for next year. So that is what a V-tail recovery would entail. The other scenario is that you at least in end of 21-22, you at least get back to where you were in before the crisis. And for that, still also you'll need about 7.5% growth in the next year. Then you are back to where you were. So for 2 years, you have not grown, but you are back to anything below that, you would actually be, would still be lower than what you were in 1920. So now which of these scenarios is more likely, or towards which is closer to this? I would say it is the latter scenario. And the reason is that we have some advanced estimate, we have some estimates which have come in, and these estimates typically are derived from projections from the formal sector, for which data is readily available. And we know that it is the informal sector, small businesses, and job destruction is actually not reflected in this. So this might be overstating growth. And then unlike the Western countries, where you had a large fiscal stimulus, so which could keep small businesses and people without income going without actually going into drawing down their savings. That has not taken place. There has been, and much of this actually is currently masked by the regulatory forbearance. You had the moratorium, and then you had measures taken after that. So the actual what you call business destruction might actually, there'll be more down the line. And if you see RBI's financial stability report, it talks of a sharp increase even in the baseline in NPAs. So, and then once we go on to what was the economy before COVID. Now, before COVID, you had several quarters of declining growth. I mean, each successive, and the last was less than 4%.
Right.
And that is the scenario without COVID. So how do you, and the reason behind this was that if you consider growth as consisting of three engines of growth: exports, investment, and consumption, serially one by one, started, shutting down. And how do you expect this thing to change? And even if growth were to, revive, you have your banking crisis there. The twin balance sheet problem remains. The banks are hesitant to lend, and you have corporate balance sheets that are impaired. So, as pointed out by Jasprit, is that you would still have some businesses which will do very well, which will recover well, and some which are going to really struggle. So the next shape is the K-shaped recovery that which people are talking about, that some will do well, especially the technology companies, and some where, because restructuring is taking place and businesses have collapsed, they will not come up. So, but if you sort of average it out, you will have this, what I call the swoosh recovery. It's a very, like a shape like the Nike logo, that it is going to be a very gradual recovery. So I would say there would be a rebound, because the fall has been very, very sharp. And, when they say a dead cat bounce, that the higher it falls, from a greater height, the more it seems to rise, but then it will go down. And so and then what is the role of the RBI? So one thing we have not discussed is monetary policy.
Right.
And monetary policy, if you have a banking crisis, it's like pushing on a string. You may lower rates, but if banks are hesitant to lend and businesses are, the balance sheets are impaired, how do you get the credit going? And this is what has happened. You had fairly easy monetary policy, but where has been the credit growth? And that thing is going to persist even post COVID. So as I say, I'm not very optimistic on the economy going forward, and I see, as I said, a Nike swoosh recovery. I'll stop there.
Anant, if I can turn to you. So given this scenario, what is your ask from the budget for the banking sector?
Right. Look, I guess the ultimate thing for India really is about jobs and output. If we can get output and jobs, every single macroeconomic variable that we're concerned about, whether it is growth, inflation, export, everything will come through, right? Consumption, and Professor Sheel mentioned, consumption, exports, investments, everything will go into a nice virtuous cycle. So, we talked about the financial sector, we talked about digitization, we didn't talk about the real sector. A lot of the problems that we saw in the financial NPAs, etc., was because the real economy was not performing. You give infrastructure loans, and then you have a whole set of real sector issues which come in the way of implementation, execution. What do you expect to happen on the financial sector? Anyway, but coming back to your broader question, what would you like from the finance minister particularly for the financial sector? Look, the fiscal deficit is looking terrible. Okay, my own expectation is that for this fiscal year, FY21, this combined center plus state true fiscal deficit, because again, that Satyameja Jayate works in the fiscal numbers as well. It's all a complete balderdash. The actual number is probably 15% of GDP. Okay, so it's a gigantic number. Next year, things will improve because our economy will recover. Tax income will go up. But even so, your central fiscal deficit could be somewhere around 6% of GDP. Okay. But here is the deal, Sawan. So I wouldn't mind the government spending more money. Okay, I'm supposed to be a fiscal hawk, by the way, but I wouldn't mind the government spending more money as long as they do a few things. One is improve transparency. Don't give us this gyan about off balance sheet, on balance sheet, flowery revised estimates and all that stuff. Give us the truth. Okay, first part. Second part, reduce your revenue expenditure, push money into capital expenditure. And this includes not just into infrastructure, which is obviously required, but also into things like education, into nutrition, into healthcare, into public services, including sanitation, etc. These are all close to our heart anyway. push money there, I'm all for it, because I think it will go a long way into this whole point about creating jobs and output in the country. Then comes this, look, a lot of good things are happening, to be fair to the government. I keep criticizing the government, but there is labor reforms, there is, taxes have been brought down, the corporate taxes have been brought down. They are doing PLI, the production linked incentive, to try and bring in supply chains into India. So they are trying what they can try. But effectively for actual jobs and output to come about, you finally need the financial services ecosystem to be able to fund our growth as well, right? Our entire credit to GDP, the discussion that we had earlier. So what we discussed earlier, one is, please go about doing this entire 4R structure, which is, recognize, recover, recapitalize, as well as reform. And then reform is extremely important. Look at PJNI committee, look at maybe the possibility of a bad bank or some solution for the NPAs that you have currently, and put in place. Essentially today, bankers are simply not able or willing to lend. We talk about the ability and willingness of borrowers to pay back. Here, you have the lender itself not able or willing to lend, right? And you want that ecosystem to be thinking about lending again. For that to happen, you do need these 4 hours to go through, and I'm hoping that happens. And accompany that with fiscal spend, accompany that with reforms to try and make it easier to create jobs in this country. If people like Mr. Bindra want to create jobs in this country, they shouldn't have to run from pillar to post. They should be welcomed with open arms, as they were in China 20 years ago, right? Put out a red carpet and bring them in. So I'm hoping that happens. It's a tough order, but Sound, it's not going to be easy. As I said, it's easy for a professor sitting on the chair out here to say, do all of this. It's much more difficult to implement this. We're already seeing the protests against the agricultural reforms, for instance. So imagine if they say we will do banking reforms, which sounds like privatization. Imagine, and plus they've already done labor reforms. Imagine the kind of protests which can come. So it's going to be a tough ask, but I think it's an opportunity. The bottom line good news though, Sawan, is there is no problem in this country which cannot be solved. I think every problem can be solved. Hopefully we solve the problems because of the government rather than despite the government. And the budget can be a good starting point to that.
Wonderful. I think we are into the last few minutes of our discussion. And there is a question that I see on the chat. This is, I guess, any of you can take it. What will be the share of digital banking in India in 2025? Any guesses, or if you have any numbers that you can project?
Sorry, I jumped in because I saw the word.
No, please.
I'll speak on the digital part. The bank part, someone else can take it. But I would rephrase the question as to whether there will be a digital bank till 2025. Okay, a purely digital bank, the way digital banks are supposed to be. Look, there have been in India. We're talking about India, obviously. There have been attempts. DBS, which was spoken about, actually has actually forayed into. They did a whole internal experiment within DBS globally and chose India as a place that said that they would do an end-to-end digital bank, and they tried. But I don't think, without knowing too much of the subject, I don't think our regulation allows that entirely. The other one, which is more famous probably, is 811 by Kotak. And just as a side interest, 811, the name came out from actually the date of demonetization, which was 11/8 actually. And so, or 8/11. And so, the 8/11, that's right. And so did Kotak, and it's not really taken off. Okay, again, because of, I think, more systemic intrinsic issues. And very frankly, I think an existing institutional trying to start a totally digital institution within itself usually does not work as well as a technology company or a pure startup doing that. There are conversations, there are startups which are trying to do neobanks. There are blockchain-based solutions which are kind of being talked about out there. But I would be very happy if we have a purely digital bank, if there's an enabling regulation infrastructure to have a purely digital neobank in India by 2025 rather than even share of that. So that's my opinion.
I think that answers it.
Can I just add, Sawan, if you don't mind?
Yes, please go ahead.
With the caveat I mentioned earlier that I have zero knowledge about technology, but very quickly, I think, look, what Mr. Bindra said, which actually struck a chord with me. I'm okay. Disclosure: I'm on the board of a bank, but I can tell you that every bank thinks of itself as a tech company now. Pretty much, you hear this buzzword of digital in every bank now, and every bank which wants to make a difference. Second thing I want to add is, the power of digitization is not just for ease of access and financial inclusion and stuff like that. What we discussed about in terms of NPAs, a very quick story is on. In 2018 beginning, I think it was, no, 2019 beginning, there was a report which came out from REDD, a company in Singapore, a very small company, research company in Singapore, which talked about a particularly large HFC, which has since gone bust. But anyway, so that particular company, where it did a forensic about how this company was siphoning out money allegedly. And it gave a lot of details about REDD. You can Google it up. It gave a lot of details about something called box structures on how this money was being siphoned out and taken out of the country. Okay, taken out of the ecosystem. I happened to call the analyst who wrote this because it had an incredible amount of detail about which company name, how is this box structure being created, who are the people involved, and so on and so forth. So I called this analyst. This was a 35-year-old analyst sitting in Singapore, and he claimed to be completely underpaid. So I asked him, who's your source? I mean, who's given you all this information? He said, my information is Google. And I just know what questions to ask to Mr. Google. Okay. And this completely blew my mind. So he was actually right. So, in the MCA website, there's a tremendous amount of data. There's a lot of chatter on social media. He was actually mining all of that and thinking through or listening to all of that and coming up with this analysis. And he put the pieces together. And then he had a counter question to me. He said, I'm one underpaid kid sitting in Singapore and having zero access to whatever is happening in this country. And I can tell you there is this problem with this particular entity, which by the way went bust eventually. You've got an army of bankers, credit officers, research analysts, rating agencies, auditors sitting in the country. What are you guys doing? And why is it taking you so long to figure these things out? So look, one of the problems we have in this country, average deposit rates as per RBI report has come down to about 5.6%. 1 year CD rate is about close to 4% right now, right? I can tell you bankers who tell you that I can still lend to good credit at 14-15%. Now, either they're smoking something or we are so underbanked that you can get away with murder. But the difference between the lending cost and the borrowing cost is still extremely high. And one reason for that is lack of trust. If you don't trust your borrower, you're going to charge the moon, right? Information can actually make that life of the credit decision a lot easier. And this is, again, an area where digitization can really help, giving, the whole process of disintermediation, giving me comfort that the borrower is of good standing. We have GST data now. We have CIBIL scores, of course. We have a plethora of data available on cash flow. Everything is getting digitized anyway. So if you can get access to that, you can get a lot more comfort around credit and therefore bring down this gap that you have between cost of funds and the for borrower and for lender. So I think the future is bright. Digitization is inevitable for banking, even though I don't understand the first thing of it, so I'll become redundant. But it is definitely, the future is bright, and I think we will go down that path. And in a way, we are good because we will skip a whole part of the banking that the US, etc., went through, and we'll go directly into digitization of banking, which is probably good for us.
Dr. Sheel, you wanted to make an intro.
Yes, not a comment, but I have a question for our fintech expert. Just a query is, digital banking or greater use of technology in banking, and you referred to that you see technology companies going into banking rather than banking companies becoming more technological. When you talk of what about things like developmental finance? Because Tamal had referred to the whole question of on-site and off-site, and in developmental finance a question of judgment and on-site scrutiny and monitoring are very important. So to what extent can technology take care of, and India needs a lot of developmental finance, and much of the NPAs relate to the infrastructure finance, and that problem, and if you're going to get infrastructure finance going again, this problem will remain. And historically, I think there was a World Bank study in the 90s or something where they said that much of the investment in infrastructure in developing countries was directly or indirectly funded through the fisc, either through tax tax exempt bonds or directly from the fisc. And in India, we have relied a lot on the market, and the capacity of the market to be able to absorb risks in infrastructure is fairly limited. So this problem remains with us. And how will the digital technologies help?
So first of all, let me disabuse you of the impression that I'm a fintech expert. Okay, yes, I do work in technology, but fintech, there are vastly better people, much people who have really worked in that far more than I have. So let me just take this in a slightly more general way, Dr. Sheel, if I may. So first of all, I am one of those. There are these two schools of thought in terms of technology and human beings. And once there are two extremes. One extreme is that there are certain things which human beings can only do, which technology will never replace. And the other extreme is AI, especially, or what is more precisely referred to as AGI, or artificial general intelligence, will eventually replace everything that a human being does. Actually, for the second school, there have been a bunch of things, especially this year and to some extent last year, which have lent a lot of credence to this AI replacing human beings. There have been advances which were just unheard of. Something called GPT-3, which can actually write novels, create text, answer questions much better than many human beings can, in a very instinctive manner, a human manner. Games being played, Rembrandt art being created by AI, which you never thought. There are a lot of things that we believe that we are heading towards that route. Now, what I believe and what most of the technologists have come to believe is that neither of the two is actually going to be happening. In a lot of ways, it's somewhere in the middle, where AI or technology will help a human being do his or her job better. Okay, and so there are certain areas which it's going to become extremely difficult for technology to do a human being's role. Most of the time, sometimes people refer to the real AI as not artificial intelligence but augmented intelligence. Okay, where there's a human being augmented with technology, or a technology augmented with human beings, which could help solve or do some of the things which were difficult to do. I mean, the Google example is a primitive form of that, where you didn't need an army of people. There was a human being who still had to put this thing together. He got all the information, etc., but he still had to connect the dots, make the story, create this whole picture together. And technology will only be able to do that in a limited fashion, not the whole thing. And so, I will not be in a position to answer your specific question regarding developmental, but some of the decisions which were being taken in a purely human, non-transparent, purely subjective manner could perhaps become more transparent, more objective, and happen faster than what they were. You've also mentioned governments. In fact, the last thing that I would say, that one of the things which is actually going to happen more and more is that the role of governments in technology is going to become bigger rather than smaller. There was this whole thing that technology and government should be separate. Government stays away from technology, but now the way that technology has become so powerful, you've seen what is happening in the US, or Microsoft opening a UN representative body, etc., that technology is becoming super powerful, and now actually government is going to have to come in and regulate vast portions of that. And so they will actually start working together in multiple ways, including in some of the ways that you mentioned. So as I said, I'm not a fintech expert. I would not be able to answer your specific developmental banking question, but on a more general basis, I believe that technology could come in and help supplement what human beings are doing to make it better, faster, more transparent, with more information, more objective rather than subjective.
Thank you. So, in fact, Dr. Sheel, I hear that there is talk about reviving the DFIs, but we'll have to see about that. So thank you all. I think we are completely out of time, and we have to unfortunately bring to close this discussion. Vasundhara, if you would actually just give the vote of thanks.
Good evening, everyone. I would like to take this opportunity to thank all our panelists of the session, Dr. Alok Sheel, Mr. Tamal Bandyopadhyay, Mr. Jaspreet Bindra, and Mr. Anand Narayan for taking the time to share their valuable insights with us today. Regret from Dr. Rajat Kathuria, who could not join the session. I would like to thank Dr. Shaunre for moderating today's session. I would also like to thank the team at ICREA for their support in organizing this webinar. Finally, I would like to thank all the attendees for joining us today. Thank you.
Thank you.
Thank
So
you.
we close with that. It has been a wonderful discussion. Thank you all.
Thank you very much.
Thank you.
Shaun.
Bye-bye.
Anchor and moderator. Thank you so much.
Thank you.
See you, everybody.
See you. Bye.
See you, Tamalda. See you.
Bye. Bye. Stay.